Recall in our last segment, we noted that we had mitigated a lot of risk, but there's still some nearby risk related to reductions in prices and yields, and that we might have some other avenues of risk management to help offset those risks. One of those that we're going to discuss in this segment is variable land rent. Recall that early on we assumed that land rent for our Madison County farmer was all in cash. If, however, the farmer had agreed with the landlord to share some in the downside risk, but also share in the upside opportunity, we have a feature built into the model to allow for this. There are a large number of possible forms of crop share or variable land rent arrangements. We currently provide one form of rent variability to allow the farmer to model the impact of variable land rent and its impact on particularly managing nearby risk. For our model, we assume that the landlord and the farmer can agree on a benchmark revenue, and then they'll calculate an actual revenue, and to the extent that the actual revenue falls short of the benchmark due to either prices, yields, or some combination thereof, then the agreed upon sort of fair market rental rate would adjust upward in a good outcome scenario and downward in a poor outcome scenario, and provide therefore offsets both ways. And the way we go about doing that in particular is as follows. We first assume that the farmer and the landlord can agree to, as part of this contract, a baseline yield that is reasonable and appropriate for purposes of the market, and we assume, and that's where this is entered in this section 213. We're going to assume that that's the same as what we're using as our budgeted yields, and we'll assume that the farmer and the landlord can also agree to a rented land cost per acre as a fair benchmark starting point. For purposes of calculating the revenue benchmark, we assume that we use for a price the projected price as calculated by for crop insurance. So in our case, we would assume that the farmer and the landlord agreed that they would use for the revenue benchmark calculation the discovered spring price of $5.91 in this example. So for our example, the farmer and the landlord would agree that 213 is a reasonable yield for corn. 591, whatever became the discovered projected price for the spring, would be the benchmark price, and that would produce a benchmark revenue per acre for corn, in our case $1,259. To the extent that down the road at harvest, we would then use our actual farm yields as measured off of our actual farm yields multiplied by the crop insurance discovered harvest price. And if our actual revenues fell short of the benchmark, there would be a reduction to rent proportionate to that shortfall. And if our actual revenues exceeded the benchmark, there would be an increase in land rent proportionate to that excess, subject to a cap. I know that's a little complicated, but let me show you how that would work. I'm going to go back to the dashboard. The way we set that up is as follows. We'll go into farm-specific data. This is where we originally set our cash rent, our acres as straight cash. We're going to now put those as variable. So we're going to move our 1,500 cash rent acres out of cash rent, straight cash rent, and move them to variable rent. 1,500 acres. And we're going to assume that if 282 cash rent an acre is a reasonable starting point, the landlord will be willing to accept a 10% reduction in land rent or a $28 reduction in downside scenarios in exchange for getting an opportunity for an additional $28 in land rent if revenues turn out positive. So we'll put a 10% cap and floor. We'll update that. We'll go back to the dashboard. And what you'll see here is here's where that adjustment takes place. And you'll notice this is the revenue-based adjustment to land rent. This was 0 before, but since we've now set this at variable, and recall by March 10th, our prices have fallen pretty significantly from the projected price for crop insurance. We're already expecting today to have lower rental rates than the market rate. In fact, you can see here, instead of $282 per acre, we would expect, sitting here today, to have $266 for our corn acres and so forth, and for our overall farm, $270. So the notion here is that if the farm outperforms on yield, or prices move up, or some combination, the farmer would be willing to pay a higher land rent in that scenario in exchange for getting some protection on the downside if yields didn't come in or prices fell. So now let's look at that from the standpoint of our sensitivity tables. And what you'll see is, as expected, there'll be a trade-off. Costs will be a little lower when prices and yields are lower, and costs will be a little higher when prices and yield are higher. And it will provide some very helpful nearby protection for the farmer, kind of like an insurance policy without a deductible. And here's our new picture of a risk profile, kind of like that. It's all green. Nearby, we're looking a lot better than we did before. And let's show what those differences were. So using that arrangement that we specified in our model, and a 10% floor and a 10% cap on land rents, this is the impact. In downside scenarios, the farmer will pay $42,000 less in land rent. And in upside scenarios, the farmer will pay $42,000 more in land rent. And that helps mitigate, in this case, some nearby downside risk, in particular in this area. So variable land rent can be used effectively to mitigate risk, and it's obviously something that would probably need to have been discussed and put in place well in advance of these discussions that we're having today. Would probably have been put in place in the fall in the prior year. But it is a very useful risk management tool for the farmer in developing their picture of risk, and if they're willing to trade off some nearby downside for some nearby upside, trade off some nearby upside for some protection on the downside, it can be a useful tool.